So, our boy Donald Trump is proposing a $2,000 stimulus check to low and middle income Americans.
And one of the things we're going to do, we're going to issue a dividend to our middle income people and lower income people of about $2,000. And we're going to use the remaining tariffs to lower our debt. We're going to be lowering our debt, which is a national security thing. So we're doing a lot of good work.
If you ask me, I think this is actually very, very bad for the stock market because, yes, we might get some short term liquidity. The stock market might rip a little bit on that because, hey, maybe people will put this into the stock market. But at the end of the day, it's not really going to move the needle. Like if people just invest a couple $1,000s in the market, it's not enough to push the market higher. But what could this actually materialize into? And why is this actually a lot worse than what many people think? And honestly, like Trump is kind of just shooting himself in the foot, in my opinion. So let's take a look at the chart right here and try to figure out what happened in the past to figure out, hey, this is probably going to happen right now. So 5-year chart right here of the NASDAQ, we're going to take a look at this dip that happened going from 2021 all the way down here to 2022. You can see that the NASDAQ fell roughly 35%. Why did this happen? It's because inflation got out of control. And when inflation gets out of control, what does the Federal Reserve choose to do? They choose to raise interest rates. We could go over to the chart and see what the Federal Reserve did in that time period. Interest rates went from basically zero all the way up to roughly 5.3%. Why? Because inflation was getting out of control, and you can see that on this chart right here. Inflation coming out of COVID honestly wasn't really that bad. It was below the Fed's 2% target. But then once the stimulus checks came and once the money printer went burr from the Federal Reserve, wow, inflation went up all the way over 9% because there was just so much liquidity and so much money just injected into the system. And the Federal Reserve simply just kept interest rates low and they kept them low for too long. So people were blowing money like crazy. They were blowing their stimulus checks. There was all this demand just being injected into the economy. And then it's like the price for everything just went up. Airline fares went up, home prices went up, car prices went up, food prices went to the moon. Remember like egg prices and milk prices and toilet paper prices? Like all that stuff got like totally out of control because there was just this supply demand imbalance. People had money, so they were then willing to go blow it. So, what did the Federal Reserve have to do? They had to act very sharply because, again, the Federal Reserve's job is to keep inflation in check. They want to stay around that 2% target. But at the same time, they want to support a strong economy. They want to have a good labor market. They don't want to have high unemployment. They want to find this perfect balance between the two right there. But once inflation started to get out of control, because there was all this liquidity, like I said, injected into the stock market, they had to raise interest rates. Now, when you raise interest rates, what does that actually do? It's going to raise the interest rate on the bond yield. So if we just take a look right here on the 10-year Treasury bond, go back to before interest rates went up, you can see the yield on the bottom right there was 0.84%. Right now we're at 4.1%. So you're going to be like, well, Brandon, I get it. Bond yields went up. Like, why do I really give a crap about this? You should care because the stock market averages roughly 10% per year. So just think about this. Like you wake up in the morning, you have a bunch of money and you want to just go invest it. What is your goal when you invest that money? You want to make the most amount of money as possible with the least amount of risk of losing that money, I guess. That's what we're all here to do. So when the bond yield is below 1% and the average annualized return in the stock market's like 10%, nobody's going to waste their time on a 10-year bond to lock up their money for 10 years. It's just not worth it. So what do? They're going to put their money into the stock market because, again, there's really no debate at that point. But right now, you could capture a 4.12% guaranteed ROI for the next 10 years if you put your money into a bond. Okay, I get it, Brandon. Why does this actually matter, though? My point is this. As more stimulus and more capital gets injected into the stock market and gets injected into the economy, that is likely to cause inflation to tick higher. When inflation ticks higher, what does the Federal Reserve want to do? They want to keep interest rates flat or potentially even raise them going forward. And if you listen to Jerome Powell's most recent Federal Reserve meeting, he's trying to tee up no interest rate cuts at the upcoming meeting in December. Let me get myself out of the way. You can see that right now we're at 3.75 to 4% for our current range, and there's a 62% chance that we get a cut where we'll go from 3.75 to 3.5, but there's a 37% chance of no cut that we stay flat to where we're at right here. So what's going to happen is if we get this stimulus check, it's likely that that money is going to go into the economy and Jerome Powell's going to start to get nervous because, hey, not only do we have to worry about tariff inflation coming through the economy, but we also have to worry about, hey, now we have this stimulus money going through the economy. And it's like, yes, that's going to help out the labor market because the labor market's slowing down quite a bit right now because AI is taking jobs. So it helps on that side, but then Jay Powell's like, well, crap, now we might have this inflation problem. And if we flip back over here to the CPI chart, it's like, dude, the Fed's target is 2%. Right now we're at 3%, and we're on an uptrend. So as we're on this uptrend and we're about to inject all this capital into the market, it's like, you kind of got to scratch your head. And if you're Jerome Powell, it's like, what the heck do we do right now? And if you ask me, like, yes, the government's reopening back up and we're going to start to get more data with inflation and the economy and jobs and stuff like that. So it's going to become more clear what's really going on out there. But the overall consensus is that inflation's ticking up and the economy is slowing down a little bit and the labor market's slowing down a little bit. So Jay Powell is just torn between the two things of what to do right here. Now, when we go back to the chart right here, you could see that the Federal Reserve clearly opted to raise interest rates pretty rapidly. I remember they were raising by 0.75, like multiple meetings in a row, to really try to get inflation in check. And when that happened, the stock market went down 35%. So you're like, well, Brandon, we're not going to raise interest rates by 0.75% for the next few meetings in a row. And you're right. I agree with you. We're not. But what I am saying is this. Inflation is on the rise. Inflation is starting to tick up a little bit. And this is all at a time that the stock market valuation is a little bit lofty. So if you just take a look at this chart, you could see that the PE ratio of the S&P 500 is pretty similar to what it was in the 1999 dot-com crash. You're going to be like, okay, I get it. The market's a little bit lofty, but again, why are the stimulus checks going to potentially crash the economy and crash the stock market? That's why I clicked on this video, Brandon. This is why. The stock market is pretty much priced for perfection. If we don't get perfection, it's going to dip, it's going to breathe a little bit, it's going to go down a little bit. So up here at this 24 PE ratio level, the market is assuming that we are going to get those interest rate cuts. Again, you could see it's a 62% chance that we are going to get that cut. But in my opinion, like, I'm leaning towards this cut is not actually going to come. And once the market starts to realize, like, hey, we're going to get this stimulus, inflation might start to tick up, the Fed's going to take a little breather here on interest rate cuts, what's going to happen is the 10-year bond is probably going to go up in yield. And when this goes up in yield, it's going to make bonds look more compelling versus the stock market. Like if the 10-year bond yield trends up to like 5%, and then the stock market typically will average 10%, it's going to be like, okay, I still want to get to 10% in the stock market. I'm not going to waste my time with the 5%. But if we go back to the valuation chart and we really like weigh this out, do we really think that the stock market's going to do 10% per year for the next 10 years going forward on average? In my opinion, no, because the valuation level is already a little bit hot. The valuation level is high. And just to hit on this a little bit more, right now we are at a 24 for the S&P PE ratio. What are the forward subsequent 10-year returns expected to be? This goes all the way back to 1985. So since 1985, it's directly correlated that the higher the PE ratio is down here on the bottom, the higher the PE ratio, the worse your returns are going to be. So 24, how did the future expected returns look? Not really too good, simply because so much is just currently already priced into the stock market. So what do we do right now and how do we capitalize? Well, in my opinion, I honestly don't think that we're going to get the stimulus checks. That is the whole caveat to this whole video right here. I honestly would be surprised if we get it, simply because the timing doesn't really make sense right now. Maybe we'll do this closer to a major election so that it helps the Republicans get more votes. That's something that we could consider here, but I just don't think it makes sense when we have potential for stagflation, which is higher inflation and a weaker economy. I just don't think that it makes sense to inject this capital into the stock market and into the economy right now. And if we do, like, it's just going to complicate things. And the Federal Reserve, they were trying to tee up no interest rate cuts for the December meeting. I do not think that we're going to get that interest rate cut kind of regardless here. But if we get this stimulus money, I think there's no chance that we get that interest rate cut. So this is pretty much priced in right now as likely to happen. When the market realizes, hey, we're going to unprice this interest rate cut, the stock market's going to correct a little bit lower because, hey, we're not getting that interest rate cut. Bond yields are probably going to go up a little bit. It makes that look a little bit more compelling versus the stock market. So we're just simply not going to put that money into the market right now. We're going to go buy the bond because it's guaranteed. The stock market's too expensive. It's too risky right now. That's probably what I feel like is going to happen if we honestly get this stimulus check right here. All right, so here's how I'm going to play this. If we get the stimulus check, like, yes, we might get a short-term rally in the stock market, but I do expect it to be short-lived because, again, we're probably going to get less interest rate cuts. When we get less interest rate cuts, that's bearish for the stock market. And the Federal Reserve right now, like, they're already divided enough. Like, there's people so far on one side and so far on the other side. Like some people are literally saying to hold interest rates slash maybe raise them right now. And some people are saying like we need to cut 50 basis points at the next meeting. So it's very divided. And when Trump's throwing this potential wrench into the equation, it's like, what the heck do we do as the Fed? So again, I think that we're not going to get the December cut. I think that's going to get priced out of the market. And when it does, I think the market's going to correct a little bit lower. And if we head back to the chart one more time, the NASDAQ corrected 35% right here. But fundamentally speaking, we are more expensive than what it was right here. So if we do get interest rate hikes or we stay higher for longer, I'm not saying we're going to get a 35% market crash. Like it's possible, but it is likely that we get a 5, 10, 15, maybe 20% breather on the stock market. So that's what I'm expecting. All right, so this is how I'm going to play it. Inside my $1.2 million account, I have all my money invested long the market. So I'm bullish the market in the long term. But how much leverage do I have right now? Not that much. How many long call options do I have right now? Honestly, not that much. Like I'm bullish on a few individual companies, but overall the market's a little bit hot. There's a lot of uncertainty right now. The market just ran up a lot. So I'm positioned to win either way. So you can see that right now my account went up. The market's closed right now when I'm recording this, but my account went up 1.92%. Here's the key thing to understand. The S&P 500 on the bottom here went up 1.54% and the NASDAQ went up 2.27%. So if we just average that, you could say that I went up maybe on balance a little bit better than these two averaged together. Like that's good. I did pretty good overall. But the critical thing to understand is that roughly 20% of this account, it's allocated to bonds that I'm collecting a monthly yield on right now until I find a better deal. So I'm capitalizing on the upside, leaving no money on the table. But if we do get downside, like if the market would have went down 2% today overall, like I probably would have went down like 1.5%, down a little bit less. So I'm capturing the same upside, maybe a little bit more upside than the S&P 500. But again, if we get that dip lower, I'm going to capture less of the lower dip. So I have capital to deploy. I have capital to go buy the dip, whether I buy calls, sell puts, buy shares, whatever it may be. I am positioned for whatever happens in the stock market because, again, perfection's priced in. There's a lot of variables. There's a lot of moving parts, and it's just very hard to know what's going to happen in the short term. All right, so if you got value from this video, definitely go like and subscribe. And don't forget about my 10-day stocks and options complete transformation. It's 10 days of me teaching you exactly every single thing that you have to know about the stock market and stock options to scale your portfolio to millions of dollars just like I did. And there's thousands of other people just like you that already went through the system. It's broken up day by day. You have the whole Discord access. It's going to change your life. Click the link below, get in for a couple days for free, and I'll see you guys there.